Oftentimes, we get asked, what is the difference between a Roth IRA and an infinite banking policy? Well, today, that's what we're going to discuss. Stick around.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today, we are going to be talking about the differences between a Roth IRA and an infinite banking policy. Anthony, we get this question asked often, and so I am excited to finally tackle this so I can just send people this link when they ask that question. Anthony, what do you got in store for us today?
Well, I would say, this is a common question we got, so we thought we would create a podcast to explain there's some things that are similar, but many things that are not. So we want to go ahead, we're going to address those, talk about why people consider a Roth, and we're going to talk about when are situations when we would recommend a Roth, and then at the end, I'm going to have a bold prediction.
Wow. I can't wait for this.
I know. I didn't even tell Cameron, so I know he's all excited to see what this bold prediction is going to be.
If this has anything to do with the Pittsburgh Steelers, I'm going to be disappointed.
No, you know what? That wouldn't be a bold prediction to say they're going to win another Super Bowl, right? This is going to be something people are going to be like, "What?
They're going to make
way.
They're going to make the playoffs next year." What? No way. All right, man. What do you think? Let's get started here.
Well, Cameron, I'm going to kick this off. I'm going to ask you a question.
Okay.
Why do you think most people consider a Roth?
No, that's easy. Taxes.
Exactly. You answered it.
Yeah,
right? You answered it.
That's the easy one. That's the first one.
By far the biggest, I might even almost say kind of the only, is advantage of a Roth is the way it's currently written is that it's going to be tax-free. But what I've told people, even before I got involved to infinite banking, when I had my tax practice, a lot of times people would put too much emphasis on the tax impact on their financial decisions. So they would consider, I'm going to have to pay a lot of taxes for this, so I'm not going to do that investment, or I'm not going to sell, or that's why I'm going to buy it. And what taxes are an important piece, but it's just a piece of the puzzle. Oftentimes people think that is the entire a puzzle. So we're going to kind of dive deeper into it more than just taxes.
Well, great, Anthony. Let's discuss some of the differences between a Roth IRA and an infinite banking policy. Let's
start since we kind of are. Let's talk about taxes.
Okay.
Right. Yeah. And the advantage of both is the policies, or a whole life policy and a Roth IRA. The big picture are taxed very similar, meaning we put in after-tax dollars, and then when we go to pull it out, we do not pay any taxes on the gain. So that piece is going to be very similar, right? But the problem we're having it's not a fair comparison to compare a Roth to whole life.
Why do you say that?
Because our goal, we do infinite banking for investors, right? So we're going to be using the policy to invest. And a whole life policy, there's not a lot of moving parts, right? But that's just whole life, right? But with infinite banking is leveraging that whole life to finance a purchase of our assets. And so we can run numbers and evaluate the cash value and the death benefit and income in retirement, but in that's what's seen. Right. I often talk about the seen and the unseen of infinite banking. What you can see is a policy. What's unseen is what you do with the policy. So thus, if you you leverage your policy, and let's say you invest in your business or you buy a rental property, now it's outside the policy, so we're going to have those tax consequences.
Mm-hmm.
So the Roth, we're not paying any taxes in it, but with the IBC, you're not going to pay any taxes on your policy. But on the investments that you do make by leveraging the policy, you will be paying taxes. So there is going to be a difference there.
Okay. Good point.
The next big difference are contributions, or really limits to contributions.
Okay.
Part of the downside of a Roth is it was called a qualified plan, which just means it's a government plan. There's certain tax rules for it, which means who determines how much you can put into your Roth IRA?
The government.
Right, it's the government. And what's funny is like right now for 2023, if you're below under 50, you can put in a whopping $6,500 a year, right? And if you're over 50 like me, we can put in an additional $1,000.
Wait, you're over 50?
Yeah, I know it's a big surprise, but yeah, I am over 50.
Mm-hmm.
Okay, 51 to be exact. But who sets the contribution limits on a whole life policy, Cam?
The client.
Right? The client. You decide it. Right, because the big difference between these two is a Roth IRA is an account created by the government. A whole life policy is a contract created by a private entity, contract between you and the insurance company. Now, the IRS may put limits on how that's taxed or what policies are going to be tax free.
Mm-hmm.
But as far as the contributions, you have that freedom.
Yeah.
And one thing I will say that one advantage a Roth IRA has is you don't have to contribute money each year. When we design a policy, there's going to be a required premium. So there's going to need to be something, that premium is going to have to be paid. And but again, the way that we can get around that when we're in those lean times is we can, as long as we keep enough cash value in the policy, we can use that to pay the premiums for that year. But there is a big difference in the contributions. You know, there are limits to what you can put in a Roth, but you don't have to put anything in.
Mm-hmm.
You know, but whole life policy, there are no limits, but there is going to be at least a required premium each year.
Great, Anthony. So far I've heard kind of two topics that you touched on: taxes, contribution limits, and then the third one. What do you got for the third piece here?
Is investment options.
Okay.
Right. What can we do with the money that is in each account? Again, a Roth is created by the government, so the government sets the rules.
Mm-hmm.
So there's going to be limits of what you can invest in. And one thing we got to be careful. We need to read in between the lines when the government is trying to create some bills. And last year, I think it was in the Inflation Reduction Act, which is kind of ironic name, but
that's how they all are named.
Right.
Yeah.
But what's interesting in there, they were going to put limits of what additional limits of what you can invest in inside your IRA. Because a lot of times people think that we can only invest in the stock market, which is what probably 95% of the people do. But you can do what's called a self-directed IRA. And that will give you some more investment options. But the government was going to put additional limits on that. And what was interesting to me is that they're really pushing people to invest in Wall Street. Mm-hmm. So it's going to make it harder for them to create to invest in the real assets to what a lot of our clients are investing in.
Mm-hmm. Well said. So that's three. We got taxes, contribution, investment options. And what do you got for a fourth one here?
I tell you, this fourth one I think is the most crucial one,
mm-hmm.
and that is access. right? Now, a Roth is designed where you're not going to touch that money or can't without a penalty until you're 59 and a half, right? And sometimes that's okay because in theory, this is some long-term money is kind of how it is sold to us. But the big thing with a lot of our clients and what we're trying to teach people is to get financial freedom. And that financial freedom is not waiting till we're 59 and a half, right? It's waiting until our passive income is more than our monthly expenses. And when we have money in a qualified account, whether it's a Roth or a traditional IRA, we can't use that money to pay our monthly expenses. So if we create that passive income, that's great, but it'd be very difficult to use that to create financial freedom. And also, a big problem people have is we're not saving. I know, Cameron, you are big on the difference between savings, investing, and speculating. And what most people doing, they think they're investing, but they're speculating in the stock market. Or really, I think that they think they're saving.
Yeah.
Right? But they're not. They're speculating. And the problem is when life happens, I mean, things are going to happen. And maybe there's a loss of a job, or there's a large repair, or there's a great opportunity that just landed on your lap. If your money is tied up in these qualified plans, you may have difficulty accessing it, which means you may miss out on those opportunities. Or when something negative happens, if all your money is in an IRA, you're going to have to go borrow money, right? You're going to have to use credit cards, and you're going to start having all of that debt. So having that access to those funds, I think is super important.
Great point. So we touched on 4: taxes, contribution limits, investment options, and access. And we've got one more that we'll add on there is income limitations.
Oh, I didn't even mention about the contributions.
I know. I was waiting for you, but I'm here to point out your mistakes.
Yeah. Well, thank you, Cameron.
Exactly.
And I guess I can say you're welcome because I know you know that you enjoyed it. Another thing I didn't mention is the government again puts limits on who can contribute.
Yeah. So
if you're making a modified gross income, if you're married, I believe it's about 228. Single about 158 or 138, which means then you are not going to be able to even contribute the whopping $6,500.
Yeah.
Thanks for pointing that out, Cam.
Absolutely happy to help. All right, Anthony. So great overview: taxes, contributions, investment options, access, and then also some income restrictions. Anthony, question for you: is there a situation where you would recommend someone contribute to a Roth IRA?
Yeah, there are a few, right? And what a lot of people might think is, well, hey, if somebody just doesn't want to take an active role in their finances, a Roth IRA can be an easy option. I still wouldn't use a Roth IRA in there, because what I would recommend is the problem is we're trusting our retirement on the stock market and Wall Street. Also, we're tying up the liquidity of those assets, and also I'm willing to bet those people that don't want to take an active role in their investing are underinsured with the death benefit. So I would say if somebody doesn't want to take an active role and they just want to put their money in an account and have some reliability that it's going to be there, I wouldn't do a Roth. I would just do a infinite banking designed whole life policy, right? Because this way you don't have to worry about the market. Now you're going to have some permanent death benefit, and when life happens, you're not going to have to go to the credit card. You can go to your policy and then pay it back. Okay.
Interesting. I was going to say interesting response. So I'm going to pose the question to you again. Right?
Because I didn't answer it.
You didn't answer it. Is there a situation in which you would recommend someone fund a Roth IRA?
There is, Cameron,
Okay.
and I'm glad you asked.
Yeah.
And so a couple of them that I would recommend is if you want to get the employer match of your 401k.
Yeah.
Now, and that's assuming your employer offers a Roth 401k. So what I would recommend, if you want to get that match, I would put your contribution in a Roth IRA. So we pay the taxes now, but it's in theory going to grow tax free. And the employer match can't go in a Roth. The employer match is going to go into more of a traditional IRA. But I think the advantage of this, again, is the impact on the taxes, but also when you do leave the employer, you have an opportunity to take that money out of your Roth if you did want to. But if you do that and you have it for 5 years, the penalties and taxes are much less. So, but again, if you want that quote unquote free money from your employer, you could get that in a traditional IRA. And another thing I would recommend, where I'd recommend a Roth, is if you have parents that have IRAs that they're not going to use themselves, and the goal will be is they're going to end up passing it down to you. If you're listening to this podcast, I'm willing to bet odds are you're in a higher tax bracket than your parents are. And then if they give you a traditional IRA, you're going to have to start taking some distributions on that, but it's going to be at your tax rate, not theirs. So in this situation, particularly if they're in a lower tax bracket than you, it's probably going to be hard for them to say, hey, why don't you put that money into a life insurance policy? And that can be too hard of a conversation. But what I would recommend them do is convert their traditional IRA into a Roth. So then they pay the taxes at their lower rate. And then when it comes to you, it's going to be tax-free, and you won't have the requirements of taking that money out.
Good point.
Another thing where I think a Roth can be a smart decision is if your investments are going to be taxed at a higher rate, and you've already achieved financial freedom. Okay, so we don't need to rely on that passive income, but like there's some great opportunities of some businesses, or whether it's some syndications, or for like a prime example, we have a lot of clients doing note investing. And one of the downsides of note investing is that it's taxed at the highest rate, which is our marginal rate. But if you can get enough money into a Roth where you can use that for your note investing or any sort of investing that's going to be taxed at the highest rate, having a Roth can be a great opportunity for you.
Awesome. Anthony, I'm not going to lie. Today, I feel like I was back in the days when I had some back issues, and I was just standing here as eye candy. Today we're going to call this Anthony's interview on Roth versus IBC, but we are going to wrap this thing up, and I think you've got one big bold prediction that you're going to throw out at the end here, so I'm excited. Let's see what you got.
Okay, here's my bold prediction, that within 20 years Roth IRAs are going to be taxed. Now if you notice, if you have a Roth IRA, you can say something?
I think I know why. Yeah.
If you have a Roth IRA and you start taking distributions, you also get a 1099 for that.
Yeah.
I mean, so the government is tracking it, and what I foresee happening is they're not going to come after you and me, right? They're going to come after the quote unquote wealthy. It's going to be a number. Well, hey, I don't know what that number is going to be. But if you're in retirement and your income, say, is more than $1 million a year, well, you don't need the tax advantages.
Yeah.
So when you get that Roth distribution, you're going to pay some tax. And that tax may be income tax, or you know what it could also be is a Social Security or Medicare tax. They are going to come after that, and then they're going to set the high amount. So it's like, it's not America, it's just those evil wealthy people, right? But what'll happen is wherever they set that bar is going to eventually start winding down. Whether that's where they change what requires a tax, or simply with them printing money and with inflation will lift people up to that amount. And a prime example is our federal income tax system. I know we did a podcast on it a couple weeks ago, and when they started this, and again, in the equivalent of today's dollars, if you made $500,000, you're in the 1% tax bracket, right? So that's what it was back in 1913, right? Few people made more than $500,000, but now you make $500,000, you're not in the 1% tax bracket, you're in the 35% tax bracket. And if you have the privilege of living in some of these some states, you could be paying tax upward over close to 50%. But that's my bold prediction. Within 20 years, the IRS will be taxing your Roth IRA.
I have a bold prediction. Within 20 years, $1 million will feel like $100,000. Anthony, great interview here. I'm glad you kind of kept me around today. That was nice of you.
Me too.
But you touched on a few things, some of the differences between a Roth and IBC, the big highlights, taxes, contribution limits, investment options, access, and then also income limitations as well. And then we also highlighted situations in which you would recommend a Roth IRA. So hopefully this was helpful to you guys. Hope you guys enjoyed this episode.
Make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.